Good morning, everyone. Welcome to our live market outlook for Monday, 10th of October 2011. The trading on Asian session was actually continuation of the previous week's movements after being interrupted in late Friday US session by announcement of Fitch downgrades of Italy and Spain. And this was actually caused the sharp move lower on euro and cable and pushed the dollar higher. However, the support was found on euro found support, euro and cable found support after the latest announcement of yesterday's meeting by German Chancellor Angela Merkel and French President Sarkozy that announced that they came up with the sustainable answer for the current crisis in Eurozone debt crisis, and especially in light of crisis in Greece. And they agreed certain steps in order to solve the current actually they are going to unveil plan to solve the Eurozone sovereign debt crisis. And this is going to be announced by the end of the month. So the good and supportive news currently coming out of the Eurozone, as they were criticized also by the UK Prime Minister Cameron in his interview to Daily Telegraph, that Eurozone officials and the lawmakers are actually doing something, but always one step ahead and a bit too late, and a bit not enough action in order to solve the problem. So basically they were just holding the water not to spill completely out of the bucket, if we want to say it this way. However, now they confirmed that they are going to take some more serious and stronger measurements in order to start moving forward and try to emerge out of the current crisis that is actually big threat for whole Eurozone, and not only Eurozone but worldwide, as the default of Greece, bankruptcy of Greece would trigger domino effect and would spill over the Eurozone countries, coming Italy and Spain as the number one and the second and third biggest economies in the Eurozone, and that would be great risk for a whole Eurozone as the Union, as well as the world economies, as also the US economy is struggling to regain strength. So we are going to follow up with this latest announcement of top Eurozone officials and see if this is going to be more serious at this point and more workable in order to see some signals of the recovery of the struggling European Union at this point, and as well as Greece, which is now the number one problem in the Eurozone, pardon. So the other important to mention, the US is having a national holiday today. Also, there was a holiday in Japan, so it was a bit lighter, I would say, trading, and this is likely expected to continue during the day, as US being out of the market for today, it's going to reduce the likely number of volume and the speed of trading. However, with current conditions in the market, nothing is ruled out, so we have to keep an eye close on all markets and see what are going to be today's movements. Let's take a look now on the currencies, starting with the euro-dollar, and see the latest movements. The current near-term uptrend from 131.45, fresh 9-month low posted on 4th of October, is still intact, and regain of levels above 135 barrier keeps the positive tone in play. However, the bear trend line of 139.35 going through 136.77 high of 29th of September has so far contained the rally, and the following pullback on Friday's announcement of downgrade of Italy and Spain has triggered a sharp move lower. Support was found at 136.60 zone, which is also the zone of previous resistance, and fresh strength is now underway. The studies on the hourly and 4-hour chart are well above their midlines and still supportive, with 20 days hourly moving average maintaining gains currently at 131.34. The first obstacle we have at 135, which is the trend line, the bear trend line resistance, and then 135.23. Also, the Fibonacci levels of the broader downtrend, down move from 139.35 down to 131.45, just above 135.23 is the 134. Above 135.23 is 135.40, which is 50% Fibonacci retracement of the entire move. And then we have the strong barriers at 61.8 Fibonacci retracement at 136.30, and our strong barrier at 136.90, which is also the 38.2% retracement of just a second, 38.2 Fibonacci retracement of, if we are correct here. Okay, now it's correct. 38.2 Fibonacci retracement of 145.48 down to 131.45, broader down move from end of August. So we have the strong barrier at this point. The downtrend on euro dollar on the bigger picture currently on daily is still intact, and it's firmly in play, with 20 days moving average now slightly turning sideways. That this might signal capping the gains here. However, break of 55 days under 200 days moving average signals further weakness of the pair, and holding below 136.90 would risk lower top and extension of the broader downtrend. On the downside, initial support comes as we said, 20 days moving average on 4-hour chart at 133.83, and then we have 133.60 as the key support on the near term. Holding above the later level 133.60 keeps this positive tone in play. Loss of break below would hold the near-term bulls and allow for deeper reversal. Next level comes at 133.25, which is the main near-term bull trend line drawn of 131.45, below which would turn the outlook bearish and likely confirm the lower top at 135.23 ahead of fresh extension lower. On the British pound, again the strong near-term trend of fresh 14 low at 14-month low at 152.71, with the 156.44 seen in late Friday trading ahead of again pullback on the news of downgrade of Italy and Spain, with support found at 155.26 and fresh strength now. Basically, it's currently struggling on approach to 156.44. The regain of 156.100 keeps the immediate positive tone in play, with the hourly 20 days moving average currently at 155.80 supporting the move. Our support at 155.26 is actually the number one on the near term, and holding above here, reversal above this level would signal fresh extension higher, and above 156.44 to open way for a test of the key near-term barrier at 157.14. This is the high of 29th of August, 29th of September, pardon. And a clear break here to signal a possible forming of double bottom and allow for a stronger bounce higher, as we can see that the pair is attempting to break the main bear trend line drawn of 166.17 high of 19th of August. and currently attacking through daily 20 days moving average. So a break here in clearance of 157.14 would give some positive signal for the pair and allow for a stronger recovery, as the main outlook on the daily chart remains firmly bearish, but some stronger correction is not ruled out in case of clearance of 157.14, above which we'll have a 38.2 Fibonacci retracement at 157.86, and then 157.80. So this is actually the strong resistance area, the previous low of 12th of July, and 38.2% Fibonacci retracement of 166.17, 157.21, 52.71, pardon, decline. However, the break, as we said, sustained break above the bear trend line and clearance of 157.14 is required to confirm. Failure to regain 157.14 again would risk lower top and possible fresh extension lower, as the recent losses broke below the latest low at 153.26, and we also lost the significant support at 152.95, the low of 5th of September. So the current outlook looks quite still bearish on the wider picture, with the 61.8 Fibonacci retracement of the broader uptrend from 142.30 up to 167.45, 2010-2011 ascent coming in focus and currently standing at 151.80. Dollar yen, no big changes, still within the narrowing, I would say now, range, and forming the triangle here as the upside remains firmly capped at 77 zone, and the downside, the series of higher lows keep the pair narrowing the current range, with the immediate support at 76.67, which is the near-term bull trend line of 76.09 low of 22nd of September. On the upside, we have the downtrend, the bear trend line from 77.85 high of 9th of September, going through 77.25 high of 3rd of October. Now the break either way is required to show us the next direction. The 77.05 is the trend line, so actually this is our range ceiling and the main near-term support. On the downside, 77.60, 77.50, and 76, 60, 50, 40, 30, and 76.10 are the levels on the downside, and then we have 76.00, 75.93 record low of dollar yen posted on 19th of August, below which would turn bearish and extend the broader downtrend of dollar yen from 85.50 April high, and actually end this consolidative trading and open way for fresh extension lower. However, as always, as mentioned earlier, the possible action of the Central Bank of Japan in order to stop the further strength of the yen that is harmful for the Japanese economy is still pending and is not ruled out. So any attack at the levels below 76 might trigger action from the Central Bank of Japan. On the upside, the clearance of 77 opens 77.25, 77.85. Basically, we need to see the clearance of 78 barrier in order to confirm establishing the new uptrend of the pair. The dollar Swiss is showing signs of exhaustion at the levels at 93, as 93.13 was seen so far, ahead of our key barriers at 93.38, 27th of September, 27th of March high, and the 94.00, which is double Fibonacci level. And at this point, it's the pair is currently still in the consolidative mode, supported by 91.40, which is the previous high of 26th of September, and while holding above the later scope still remains for a fresh attack higher, and would maintain the current strong bull trend of the pair. However, on the near term, we still see consolidation with the pair price ranging below and above the 4-hour 20 days moving average. Actually keep the current trading directionless within the 150 pips range. Loss of 91.40 would be risky to open the way for further easing of the pair, and possibly to test the key support zone at 89.20, below which then would signal temporary end of the current uptrend and open way for a stronger recovery of the stronger correction of the dollar Swiss. As we can see on the loss of 89.26 would also risk test of 88 zone, 87, 86 currently, where is 20 days, 200 days moving average. However, the recent break of 20 days above 200 days keeps the broader picture positive tone still intact, with the recent consolidation seen just as a pause in the current uptrend before the bulls re-establish. As I mentioned, on the upside, the key levels at 99, 93.38 and 94.00. Now we see the commodities. The crude oil is back to strength after hitting a fresh low at 74.94. Need to mention that the broader picture still remains firmly bearish. Off 114.80, which is May 2nd of May high, with the latest low hit at 74.94 just a couple of days ago. The current recovery has so far regained the initial barrier at 83.95 that was seen overnight, with slight extension higher and clearance of 84.75. The high of 27th of September, to signal a fresh leg of the recovery and open way towards 85 as initial resistance here, and then to open stronger recovery. Failure to clear 84.75 might risk lower top and further extension lower. Despite the near-term studies being quite supportive at this point, we need to see the clear break above 84.75, 85.00 in order to signal recovery underway. And then we have 87.30 as the main bear trend line drawn of 114.80, above which opens levels at 90.57, which initially capped the recent short-term price action from 75.70 9th of August high. On the downside, immediate support comes at 81.36 and then at 79 zone, below which would be again very bearish. Gold remains in the narrow directionless consolidative trading mode after bounce from 15.32. The low of 26th of September was initially capped at 38.2 Fibonacci retracement of the broader downtrend from 1920 down to 15.32 at 16.80 zone. This is seen as consolidation of the recent bounce higher, with the break above 1680 and 1700 as a key barrier at this point, required to resume recovery from 1532 and actually signal a continuation of the current corrective bounce. 90 days moving average currently at 1665 is still limiting the upside. So this is actually the initial barrier, then Fibonacci level at 1700 barrier that needs to be cleared. 20 days moving average currently crossing below 55 maintains the negative near-term outlook, currently standing at 1700, so we have the strong barrier at this level. On the downside, immediate support at immediate support comes at 1595 and 1582, which is the lows of the current range, below which would be risky again, and open way for a further extension down to 1532, where is also 200 days moving average on the daily chart of gold. So on the upside 1680, 1700, on the downside 1595, 1580 are the levels to watch. Break of either side would define the next short-term direction for the gold.